We build a portfolio of companies. We need to select good companies and we need to select them at reasonable or cheap prices. Let's leave prices aside for today. That's a whole separate topic. Let's focus on good companies. We can do that quantitatively, we can do that qualitatively. Quantitatively, we can look at the balance sheet, we can look at debt levels, we can look at book value growth over time, we can look at capital expenses, whether companies capital heavy or capital light. We can look at mergers and acquisitions. Has the management been disciplined and conservative about that? We can look at write-offs on line items like loans and advances. And if there's a history of that, then that needs to be looked at. And we need to look at working capital. So for a high growth company that has high working capital, you're going to need more funds. In the P&L, we look at gross margin, and we can look at fixed costs, look at the operating leverage there. We can look at interest coverage ratios along with the debt on the balance sheet. We can look at depreciation along with capex on the balance sheet. And then finally, we come to the cash flow statement, where we need to look at whether the margins and earnings of the P&L are actually getting translated into cash. And it's not necessary that will happen. You might have a high margin business that has high working capital and high capex and translate. And then you can combine these three statements and come up with ratios like return on asset, return on equity. So this will give us an overall view quantitatively of the company. But everything is not quantifiable.